Good morning. It is Friday, November 14th. I am Zach Howard. Here is my weekly macro review to end the week. And it got pretty exciting here in the last 24 to 48 hours from a risk standpoint. Volatility clusters, episodes of fast action interspace with interviews of slow, dull trading. Zoom in on the fast episodes, and they are seen to have sub clusters of fast and slow sub intervals, clusters within clusters within clusters. It is a classic multifractal pattern from Benla Mandelbrot's Misbehavior Markets, my favorite book as it relates to the why that everybody is always searching for in markets. Why this? Why that? When it always usually comes down to math, fractals, laws of nature, not so much narratives, which mainstream financial media always continues to try to deploy of why something happens when it comes down to that. What we're looking at here on the left is my weekly notebook. Bullish trends in blue, bearish trends in red, highlighted asset classes that are worth paying attention to, in my opinion, under yellow. And on the right, we have volatility regime, the VIX of VIX, which is the volatility of volatility, the VVX, and on the bottom, the VIX, the volatility S&P 500. The VVX is the implied volatility of the VIX, and we never really see a big spike up here into this 111 level, but it's the rate of change in markets that matters the most, which I always talk about more than the absolute. The rate of change from meaning this 14, 15-ish on the VIX to 22, all of a sudden, with a flick of a switch yesterday, really gets a lot of positions out of candor from where they were, and where markets move so fast off machines in today's world, systematic trading takes over more than the human mind. Standouts on the left in my notebook. Not a lot of moves in the U.S. bond yields up here at the top red, 30, 10, and 2-year yields. However, the high yield space has gone now from bullish to neutral trend and is worth paying attention to, because if we are going to get continued volatility spikes and underlying slowing in the U.S. economy, you're going to see it pick up in that space for now. Not so much just episodic and non-trending. However, the small cap Russell now moved from bullish to neutral is worth paying attention to, because it is the most higher beta of those NASDAQ, S&P, and the Russell equity indexes. Way more junky companies in there, so more vulnerable to pullbacks, more vulnerable to volatility spikes. The VIX in this range here still not so much yet. We're paying attention to more than a potential just changing on the guard short-term here correction. Oil still really shitty. Really great if you're a gold miner, which continues to have higher lows, higher highs. So massive free cash flows in the mining space. My favorite trade from a volatility standpoint, if you have a continued burst of volatility above 20 on the VIX, is the car company is the greatest short when volatility is rising, and it's the greatest long when volatility is compressed, in my opinion, from studying that company over 5 to 7 years. Nothing to do with the narratives around Elon. As I mentioned, it's the ultimate volatility trade because of how much liquidity is in that name, and it's gone from higher highs, higher lows, continuous bullish trend to a pullback here now to bearish yesterday. So volatility of a major asset class, if it's falling, that's where you want to be allocating more capital and adding to it. The opposite to, if volatility rises and there's a change in trend, as we're looking at here with Tesla, that is where you definitely want to get defensive, cut your position sizing, and potentially go the opposite in that direction, that trade. That's how I'm looking at it. Bitcoin has been signaling this for the last couple of weeks, and it continues to show very poor price action, lower lows, lower highs in this bearish trade, 95 to 105. I think it's going to be continue to be under pressure here in this backdrop. Just the machine really drives the market. And when this volatility spike happened yesterday, the machines redeployed their positioning. The gamma delta in markets flipped from positive to negative gamma around 67 on the S&P yesterday. So when you're in that negative gamma environment, market moves happen much quicker on the upside and much quicker on the downside. Not so much because it's negative, it's going to go down, but it just means the moves happen quicker. And also we've seen here, great charts here from Tier 1 Alpha, the 1 month realized volatility now above the 3 month. When that happens, those systematic funds that just work off rules based, they pull back on deployment of capital, and they pull back on being on the long side, which is really cascading this selling begets selling in U.S. equity markets to end the week. Let's look further into that. Drew, one of the legends that ever played the game, George Soros. Forget him as a human for this point in my presentation, but what he was able to achieve playing the game, one of the greatest ever. Talking about volatility here from his book, Reflexivity. You want to read that book, The Alchemy of Finance by Soros. Uncertainty finds expression in volatility. Increased volatility requires a reduction in risk exposure. So when you see this move here with the VIX above 20, that's not a time to be getting aggressive on some of these higher beta positions. That's, to me, is when I pull back my beta. You raise cash, you get more defensive in your positioning. I'll talk about that here in a second, how I'm looking at that from a mock portfolio standpoint. How do we get here? I talked about how the liquidity constraints in the financial system, the plumbing of the financial markets has really been stalled because of the government shutdown. The Treasury General Account built up, causing short-term rates to rise, and lack of liquidity for hedge funds that have been borrowing in that reverse repo market. As a result, chart here, you can see the prime brokerages have been tapping into that over the last couple of years. That has added leverage to this higher moves in equities, higher all-time highs. And when you have stress in liquidity, stress in being able to access capital to continue to put these trades on, you get a pullback. And that's what we've seen. The top funds in the world continue to have major leverage on lower beta risk, lower beta trades, but it compounds over time with that leverage. However, what is a potential catalyst for the liquidity to reverse? Talked about how crypto is the most vulnerable space when liquidity pulls back, also the most biggest pops when liquidity increases. Well, the government reopens now. The government can start spending that TGA that's up around $1 trillion over the next couple of weeks, potentially taking away some of the stress in those reverse repo, lack of liquidity markets, potentially here forecasting the net issuance of treasury bills to the market over the next couple of quarters. As we've seen here, the positive issuance of bills has been a strain of liquidity if you haven't been able to deploy it back into the financial system. That's where we stand here today, the middle of November. To me, one of my favorite charts to look at every day is the Bitcoin to gold ratio. Gold is more than just a currency. Gold is currency-like because of its volatility, whereas Bitcoin is commodity-like because of its volatility. But gold is really, over the last 6 months, I think, is acting as a hedge to equity risk and bond risk globally. And with owning gold, you get to have that risk on, that hedge, risk off with that hedge without having the theta decay. When you own a option or you put on protection, like you would insurance on your home, you're buying that protection, not hoping that your home is going to burn down. You're buying for protect the value of that. But it costs money every month to have that expense, to have that insurance policy. That is the theta. With gold, you don't have that theta decay. So I think a lot of market participants are saying, you know what, I can hedge all-time highs in equities, the massive risk underlying the global credit bubble that is fixed income in bonds, by just owning gold and had no counterparty risk. So we got the Bitcoin to gold ratio, now the lowest has been since 2024. To me, continues to say risk off in this environment. I think continued bid into gold as a result. Some great takeaways here from a video I watched earlier the week about how to think about trading. Think about trading like you would playing cards. As a card shark, you're playing the odds in every hand. You're playing the probability. You don't need to play every hand. You need to think like, how can I be wrong, as opposed to how can I be right? And when the probability is in your favor, that's when you bet bigger. Don't play on tilt. If you're having massive drawdowns here, don't chase them. embrace variance in your positioning, adapt fast, easy decay monitoring. So that's what we're talking about here. When the volatility regime changes, pay attention. Keep a journal entry, like I do every day, about asset trades, sizing, all the stuff that I can use as I go forward to try to get better in my process. Develop a process that works for you, not somebody else. If you're copying somebody else's style or formula, you're never going to be able to get better at it, because you got to adapt what's anxiety less for you. How do you put on a position that you don't have the anxiety? How do you not, how do you deal with drawdowns versus somebody else? And like, that's an individual thing. It comes with time. Patience is really the key. Patience compounds. So sizing a position and getting comfortable what that position is for an individual name or an asset class, that's for me a continued work in process. Knowing your age, if you can't write down what your age is in 30 to 60 seconds, you don't have an age. The market is exploiting your weakness that you have personally, and the society that is you playing against the market, playing against yourself. My age, I do not chase bearish trends. I would short bearish trends. So for instance, now like some of these uh poor pullbacks, I would be on the short side versus the long side. And my ages, I look to buy pullbacks in bullish trends that have pullbacks. So that's how I play it. But not taking every trade, just observing the market a lot of times is really what you need to be doing, as opposed to playing every day and just working on your own process. That's what I got from a slide standpoint. Just wanted to show you some I'm continuing to work on here. It's a balanced portfolio, and how I'm looking at if I was running real money over a longer term, not doing trades, but like really managing capital. I'm tracking here the bullish, bearish trends and various asset classes just from my notebook, and down on the bottom, the various volatility regimes that I think are important to track as well. Rank asset classes, single strength on the week for bullish signaling. Natural gas continues to be number one. Silver number two, but much higher beta. Keep in mind, natural gas and silver have very high beta compared to something like gold. That's why you want to beta adjust your positions in volatility regimes that are like today, and take more exposure to those lower volatility, lower beta positions than you would have it in higher beta positions. Thinking about potential allocations to these names, I'm putting them in different buckets here. So my top bucket here would be higher beta stuff, like I'm calling it the alpha thickener zone, and I would have names here that are going to pop more, potentially lower volatility regimes, longer term plays. But in terms of these volatility regimes, I want to reduce exposure, and I've added these names here called a beta compressor, which brings down the beta to adjust in this environment from time to time. Looking at, like I said, gold as a hedge, as an inflation hedge as well. With this ETF, short the high yield space here, short in car company, short the vulnerable Russell small cap in this this shorter term time in markets. That's what I got for you today. I hope you enjoyed that, and continue to research, do some work on your own psychology and trading scheme, and we'll see you next week.